The Fed's Monetary Policy Committee will meet this week to decide once again to do nothing. Yes, interest rates are going to stay near zero, and they're probably not going to change their language that much either, which will basically say that rates will remain exceptionally low for an extended period of time.
An extended period. For an extended period.
But is the Fed really ignoring inflation right now? I think that could be something that a lot of people are worried about. Yes, the inflation in the classic sense isn't really there just yet because you don't have a strong job market, you don't have wage growth, you still have very high unemployment. But when you look at things like commodity prices, oil and gas prices have been on the rise. The dollar, despite strengthening a little bit lately, is still relatively weak. And oh yeah, the U.S. has printed boatloads of money to try and pay for stimulus and other bailout programs, and by doing that, they've boosted the deficit in the process. So that is definitely inflationary. So what do you guys think? Is the Fed ignoring inflation at its own peril, or are people like me, so-called inflation hawks, who keep yakking about inflation and the need to raise interest rates, just barking up the wrong tree? Dave Andrews is worried about inflation. He writes, anyone who has attended even a day of a basic economics class knows that the first way to devalue a currency is to suddenly flood the marketplace with more of it when what it is based upon has not changed. Sorry, I think major inflation woes for us are on the near horizon. It's a very good point. I'm not so sure we're going to have major woes immediately, but yes, for the long term, you do have to be concerned. Kurt Metzger didn't mention whether he was worried about inflation per se, but he is calling for rate hikes sooner rather than later. As nice as low interest rates are, they take away all incentive to save. And if our current market recovery is largely tied to cheap financing, which many economists say it is, then the second the rates start to rise again, we could be looking at another great slide. Painful as it is going to be, what we really need is to raise rates soon and in a steady and predictable fashion. That's something I've been calling for the Fed to do for a while. If the Fed can get ahead of any potential inflation problems, they can raise rates slowly and gradually. They won't have this need to do a big knee-jerk dramatic rate hike down the road because inflation suddenly crept up on them. There are people who worry that we're in this easy money environment yet again, like we were earlier in the decade, and that created the housing bubble and the recession. Milton Bowden argues that if you're looking for signs of inflation at the supermarket and gas station, you're looking in the wrong place. I do not see why anyone would expect inflation in consumer goods when the Fed's easy credit is not flowing to the consumer. Instead, it is being used by the financial institutions for currency trading, foreign investment, correcting their balance sheets. This can create bubbles in whatever market is hot at the moment. The way that the GDP is calculated, it looks like growth is back, even though few businesses are seeing real growth. And that's a great point to wrap up with. We are going to find out very soon how strong the economy in the U.S. grew in the fourth quarter, and there's estimates that it's going to be about 4.5% or so. The problem is it's not going to really feel as if the economy is that strong. No one in their right mind thinks that we have a robust economy, so that GDP number is going to be slightly misleading.